We were discussing about the derivatives and the list of the companies where derivatives trading is allowed. You can find the same list with every broker. Alright, it is provided by the SEBI directly. So I can see an IIFL out here. Indicative span margin equity. The share price is going to be the same. Whether you buy it in the cash market or you buy it in the futures, you'll find almost the same price. Maybe some 0.2%, 0.3% higher or lower. Okay, till this loads right. The futures. The trading in futures is same like that of what you do in regular cash market. Provided here you can sell first, buy later also, and happens in lot size. These are all the list of the contents. This is an important figure, total margin. I'll get back to this value. So this is the lot size, market lot. So the Aarti Industries, you have to buy minimum 850 or you have to sell minimum 850 or 1700. Okay. So likewise, in the multiples of 850 only, you'll be able to trade. Likewise, ACC Cement, Adani Enterprise, every company has got its own lot size. Yesterday I had shown you about Idea. You can see for Idea the lot size is 70,000. See here, the lot size is 70,000 for Idea. Alright, IDFC First Bank 15,000. If the share price is low, the lot size will be huge. Share price is higher, the lot size will be smaller. So the value will come to approximately 5 lakh, 6 lakh, 7 lakh. That is how the lot size is defined, so that the value comes to approximately 6 lakh. So only these companies derivatives is allowed. It will be approximately 200 companies. So let us take an example of one such company, which I feel that the price may rise in the sense only 3, 4, 5% within few days. That is GMR Infra. So the price is right now 38. What is the lot size? 22,500, which I am already holding it. GMR Infra. Now why did I buy into derivatives? Why not into cash? We'll discuss on that. So lot size of GMR Infra is 22,500. And what is the share price? $38. So how much do I require? 22,000 into 38. If I want to buy 22,000 shares, I would be requiring in my account 8,36,000 rupees. The same 22,000 shares I can buy, 22,500 to be specific. I can buy it just with a margin of 2.15 lakh. This is a 3 months contract, current month, next month, and then next month. That means November, December, January. You can trade in any of the instrument. Before the expiry date, you will have to cover up your position. You have bought today, you can sell today itself. You don't require to wait till the expiry date. Expiry date is the maximum time. You have sold today in the morning, evening you can cover up. You have bought today, you can sell after a week. But till the expiry date, you have the chance to make it zero. Again re-enter. Just like normal trading. Only here condition is that make your position zero before the expiry date. That is all. Now, what is the advantage of buying in futures rather than buying in cash? If I want to buy 22,500 shares of GMR, I would require more than 8 lakh. But while that I am buying the same thing in futures, I would only need approximately 2.2 lakh. So that is why this is called as leveraged trading. So write down. This will note it down and observe how the price moves. So you are able to get almost some 6 lakh interest free loan, we can say. You have only 2.2 lakh in your pocket, but you are able to buy the shares worth 8.5 lakh. So you are getting 4 times exposure. This becomes a double-edged sword. What is the meaning of double-edged sword? Either you can chop it or the sword can chop you. Remember, you have taken 4 times excess position. Every 1 rupee rise, every 1% rise, if you have bought it, let's say I bought a future, and 1% rise will increase my profit by 4% because I have taken 4 times exposure. But every 1% fall will give me a loss of 4%. This also you have to consider. So this is why it is very, very risky. I would strongly recommend never do purely futures. Never do purely futures. So who does it? Those big bank managers and all that, for hedging purpose they do it. Stand alone, no guy does it. Whoever does it is a foolish person. I'll tell you the reason also why. Now I am also with hedge. I am not only in a standalone position there. So never deal standalone future position. Combine future plus option to make it an hedged position. What is the meaning of hedged? Hedge means like insurance. The loss will be limited no matter what. Profit will be double than the expected loss. Whatever the maximum loss that you could expect, profit would be more than double. That kind of position when we create, it is called as a hedged position. So futures are to be combined with options. Standalone futures are dangerous and risky. I don't know why SEBI is allowing it. They should actually ban futures. Because I've seen a lot of retailers losing hell lot of money. Either you become super rich or you become super beggar. 25% fall in the price, that's all, your money gone. It's very common. During COVID times, stock prices fell down by 25% in a single day. Just one day, prices fell down by more than 25%. Wiped off. I myself lost huge money in the initial years of my trading in the market. So futures was the one where I lost heavy money. Came into minus account. I owed money to the broker. So when you're buying in delivery, what will happen? Maybe the price will become half, but still your capital is there. And a hope is there that it will bounce back, like in the time of COVID. But when you're into futures, it goes down by 25%, your capital is wiped off. Without money, you cannot make money in the market. So I'm giving you this knowledge not to follow, but not, we shouldn't at all go into this area. I told you complete knowledge is when you should know what to be done and what should not be done. So take these futures only as a knowledge and take in double quotes, never do standalone futures no matter what, even if you have 100 crores. In my life that I've met more than 100 people trading into futures, I haven't seen even a single person. In 100 I'm saying not even a single person who has made money in futures. You can imagine what amount of risk it has got. Because this is big players game. Where the price has to move that they know well. And they'll always play the opposite. If the public is one-sided, let's say yes bank, yes bank, yes bank, everyone buys it, they'll throw the price down till your position is cut. If everybody is short in GMR infra, selling, 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 then they'll raise the price. So likewise, it is very, very dangerous and risky to play only with futures. Never indulge only in futures trading. Keep this point in mind in double quotes. Let us write down. So never indulge in pure futures trading. I'll tell you why. After you have entered the position, in case of M to M, which is called as mark to market, loss, you will have to pay the loss amount immediately, else the position will be cut from the exchange. Write down, then I'll explain. Very important point. Alright, now what does this mean is, let's say that today I've got 2.2 lakh and with courage I enter the position of GMR Infra, I buy 22,500 shares in futures. If the price rises by 1 rupee, 2 rupee, 3 rupees, no problem, because I am into profit. But if the price falls by 1 rupee, let's say that today it is 38, by close it becomes 37. So I'm losing 1 rupee there. So my loss would be 22,500. My broker will call me and say that, Anna, please play 22,500 immediately, otherwise tomorrow I will cut your position. So this is a buffer margin that you will have to maintain every time till you want your position to be open. So from the point that you have entered, if the price moves below it, how much of that mark to market, that is what is called as mark to market, how much of difference it has got into lot size, that margin you have to keep on pumping in on immediate basis. That means you must be having some emergency fund also in your bank account in order to save your position if it is going against your view. This is the big problem. So that is what happened to me. I had 4 future lot positions. Alok Industries, TTML and all those companies were there that time. WWIL, WPIL. So what happened there is, one position was bleeding. So I did not have money because I used entire money to buy the 4 future lots. One position was bleeding, he cut that position. Because of that loss, second position had to be cut. Because of the loss in the second position, third position had to be cut, and likewise the fourth position. So it is like a pack of cards. You are arranging one above the other pack of cards. One card gets disturbed there and that entire setup gets fallen. That is what happened even during recession, subprime crisis, what we say, in the year 2007-8 by Lehman Brothers in America. That led to a turmoil in the entire economy globally. This is what happens even here. Is this clear? So either you make huge money or you would lose huge money because you are playing with 4x risk. Your own capital, you have now multiplied it by 4 times. That is how it becomes. Let's say the price rises. From 38 it rises to 40. Then from 40 it falls down to 1 rupee. No problem, because your entry is at 38. Only below 38 your broker will disturb you. Above 38 let it go to 50. From 50 let it come down to 40. No problem. That is what is mark to market. So only in case of mark to market loss, you'll have to be ready to add funds to save your position. If you do not have that excess or emergency cash, then there's no point in doing futures. Even if you have it, I'll say that don't do futures. I've stopped doing it. If I do it with hedge, otherwise I don't do standalone futures. Hope the point is clear. So that is what is your futures. It happens even on index. There's Nifty itself. Nifty and Bank Nifty, we have both. The lot size for Nifty is 50. This is Bank Nifty 25 lot size. And when you are doing in Nifty, it means that you are betting on the index itself. This is Nifty, lot size 50. So you are doing the betting on index itself rather than stocks. Alright. Now coming to options. This is where the real game is. This is what I do, and in case you want to do F&O, combine F&O. Don't do futures standalone, but options plus options can be done. Options plus futures can also be done. But futures standalone should never be done. If you want, you can note down this point in your own words. Combination of position. Option plus option can be done. Only option can be done. Option plus future can also be done. But only futures, never in life. No matter what the instrument is. These futures happen even in commodities, happens even in crypto, happens even in forex. Nowhere you should be doing it. Then what is these options? The lot size list of the companies, the lot size, list of the companies, and the expiry date remains same. However, here you will find two contracts, two types of contracts. The only confusing part in the entire stock market is options. Everything else is easy. Here only little bit of mathematical skills are required, some fast calculations is required. So that's why we'll be going little slow, and you may have to watch videos multiple times in order to get the grip over the calculation. Note it down. Alright, now why this is confusing, let me show you a sample of it. Futures I've told you is straightforward. You find one instrument, you either buy or sell. But in options, for every company, you will find hundreds of contracts. For every company, you will find hundreds of contracts. So let us say here I go with Nifty option chain. You'll find CEP, there are only two, there's no third element at all. These are all calls, these are all puts. It is only on Nifty. Likewise it will be there for Reliance. Likewise it will be there for all the companies. Let's say Adani Ports. See here, so many contracts are there. That is why option says not that easy. Let us take Nifty only. This is called as a strike price. I'll come back to this figure. And for every strike price, there will be buying and selling. For index, they have provided with weekly contracts also. I told you F&O is generally monthly, but for index, you will be able to find even weekly contracts. So let's say this is 10th November, yesterday it gone by, now 17th November, this is a fresh contract. So what is the strike price and why people are buying and selling on this strike price is what we need to understand. See, this is your bid and ask, that means buy and sell. So if you want to buy, you have to look at this price. If you want to sell, you have to look at this price. Happens even here. Okay. You want to buy, look at this price. Sorry, this price. If you want to sell, look at this price. So why people are buying and selling the index at various prices on the strike price. Strike price will be in and around the current price. So current price is 18,000. So you can take 10% lower, 10% higher. That is where people will be betting. This is actually betting. When you see this line of separation, difference in the shaded color, that is where the price is right now. This is called as at the money. This area where the difference of color starts, these two strike prices is called as at the money, ATM. Alright. Here ATM doesn't mean any time money. If you do not know that, it may be every time losing money. So understand that one figure, that ATM is very important figure for the options, because every time we will be referring this number, that from ATM, two strike prices away, from ATM, two strike prices inside, like that. So ATM, you should keep in mind that those strike prices which are the closest to the current market price are called as ATM strike prices. Now, why this is complex? Let us compare this with the cricket betting. See, yesterday India had performed very pathetically. One-sided match, lost by a huge margin, unexpected. Till first innings it looked like the match is going to be tough, but the second innings totally turned out to be the opposite of the expectations. So there are people who are betting there. Some might have bet India as a favorite team, some might have bet England as their favorite team. Ultimately, those who have put money in England, they have won, and those who have put money on India have lost. Very clear betting. That's what happens even in futures also. If the price is moving in your direction, you'll make money. Price is moving against your direction, you'll lose money. Simple math calculation. Your entry price minus the exit price. Sorry, exit price minus the entry price. That is what your profit loss would be. But in options, the betting is as such. So you want to bet cricket betting, you choose your favorite team, I choose my favorite team. This is one way of betting. But if you go to UK, betting is legal in UK. UK, Australia, in America, for some games it is legal. So there how they do betting is spread betting. Meaning, they will tell you that, see, there is a match between India and England. England is going to win the match, and by minimum 5 wickets. So double conditions will be there. You have to first tell which team is going to win the match. Secondly, you should also be able to predict by how many runs that a team could win, minimum runs. So I want to bet with you, stating that there are two types of betting I am offering you. One betting, I tell you that for 1 rupee, pay me 1 rupee if my favorite team wins. The simple betting everyone understands. But now comes to complex betting. I am betting with you, stating that, see, today is a match of India and England. I am saying that before the match starts, I say that not only India will lose, but India will lose by a big margin. My conditions are that not only India will lose, but India is going to lose by minimum 5 wickets. Then what you will say? okay, if that is your condition, then let me pay 3 rupees for every 1 rupee that I am betting. Because my condition is very tough to be achieved. First of all, my opponent feels that India is going to win the match. But then my opponent feels that, okay, even if India loses, it is not going to be so tough match. It's not going to be one-sided match. It is going to be a very thin margin by which India may lose, is what he feels. That is why he is ready to offer me a big reward. If I win, for 1 rupee, he will pay me 3 rupees. Triple amount, because my condition is tough to be achieved. But if I lose, I will pay him only 1 rupee. So my opponent is taking a higher risk. If he loses, he will lose 3 rupees, but if he wins, he will win only 1 rupee. But you should also see the probability. Chances of his winning is higher. Because it doesn't look to beat India by a big margin so easily by England. That's what he feels, and that's what everyone thought till the match got over. But because I'm taking a huge risk, for 1 rupee I'll be rewarded 3. That is how the balance is taken. Now, if India wins, then I lose my entire 1 rupee. There is no question of second condition at all. But if India loses, but loses by only 1, 2, 3, 4 wickets, then also I lost the match. My 1 rupee will belong to him. But if at all India loses by a big margin like yesterday, 10 wickets, then for 1 rupee that guy is going to pay me 3 rupees. Hope it is clear? So this is what happens in the options trading also. In options trading, let us say that today I feel that Nifty will go to 18,500. What are the chances? Right now Nifty is priced at nearly 18,000. 18,000. So from 18,000 to go till 18,100 is easy. 18,200 is little difficult. 18,300 is very difficult. 18,400 is very, very difficult. Likewise, the premium, this is called as a premium. Last traded price is the center of this. This premium will keep on reducing. So we are here. Before 17th November, what may happen? I feel that Nifty will rise. How much? 18,200. Then I can buy this betting, I can buy this contract for 73 rupees. For 73 rupees, this contract will become mine. You feel that it may rise even further, then I can bet on 18,300 contract, which is strike price. Here my risk will be less, only 44 rupees. Into lot size. Lot size is how much? 50. I feel that the price can go to 18,500, which is very difficult. That's why very cheap. How much difficult the goal is, how much difficult the target is, that much less the premium is. So that is why you'll see that the premiums are continuously reducing. Alright, but today I see that market is likely to open with a big jump. It may come here. So what is going to happen to this 44 rupees? It will become double. It will become 100 rupees. Today only you will be able to see that. Today at 9:15 when market opens, probably Monday we will be reviewing it, because tomorrow tomorrow itself we'll be able to see that. So tomorrow I'll be showing you what happened to this 18,300 contract, which is right now trading at 44 rupees. So it is, according to me, it is going to double up. That means you would have doubled your money overnight. You took a risk that market will take a big jump, and it really happened. You will be rewarded. This 44 will not be 44 now. This will increase to approximately 100. 100, 110, 120. How much it crosses, that much high returns you can get. So that you will get to know. This prices are already there, which you are noticing it, and we'll be seeing after today's market close how the prices would have changed. Alright, now write down. So bullish view means what? You are feeling that the price would shoot up. If you feel, whether it is Reliance, or whether it is Infosys or whether it is Nifty, Bank Nifty, I told you selected approximately 200 companies are there where futures and options are done. If you feel that whatever the instrument that you are dealing, the price can rise in the coming days before the expiry date, then you can buy a call. Now buying a call, you have choice of various strike prices. Now it all depends on your risk appetite. How much risk you want to take, based on that you can choose a strike price. 50 is the lot size. So 50 into 90, let's say, it's approximately 4,600. So do you want to take 4,600 rupees risk? Then you can deal with this strike price. Now you don't have that much of capacity to lose 4,600, then you can go with a higher strike price, let's say 18,500. Here the risk would be only 700 rupees because 12 rupees into 50 lot size. So the risk element keeps on reducing as and how you are choosing the higher strike price for the call. For put it is opposite. Don't worry about put right now. You'll get confused. Only focus on call. Call is when you feel that the price will rise. How much difficult, if it is a far away target, then it will be very, very difficult to come. That is why the reward will be more. Let me again give a practical example. Let's say that you want to bet with me. I say that I am having lot of strength in my arms, that if I throw a ball, it will go to 500, 600 meters away. I bet with you stating that if I throw a ball, it can go to 400, 500, 600 meters away. That much strength I have. It can go even 1 kilometer. You say that, okay, if that is the case, let us have a betting. Let us come to the field. Now in field, what happens is, at 500 meters, one flag is dig underground. Likewise, at 600 meters, another flag. 700 meters, another flag. 800 meters, another flag. 900 meters, 1000 meters. Like that, 6 flags you lay in a row. And 500 meters away from the first flag, I start with a ball throw. I throw a ball with a betting condition that if the ball does not cross the first flag, that means does not cross even 500 meters, then I pay you 100 rupees. You are betting with me, saying that I don't have strength, but I say that I have a lot of strength. If my ball that I throw goes till 499 meters also, my 100 rupees is yours. Fair? But I say that if it crosses and goes to 600 meters, then you have to rather pay me 100 rupees. The ball that I throw crosses the first flag and touches the second flag, then you will have to pay me 100 rupees. If it touches the third flag, you will have to pay me 200 rupees. Touches the fourth flag, you will have to pay me 300 rupees. Touches the fifth flag, you have to pay me 400. Touches the sixth flag, you have to pay me 500. So how much far the ball goes, that much you have to keep on paying me 100, 100, 100. That is how this betting is. This betting also happens in the same way. So how much right you are, that much big you will be rewarded. Meaning, you are bet at 15,500. If the market opens here, then also this will rise. If the market opens here, it will rise more. Let's say the market opens here, this may become 30. Market goes here, this may become 50. Market goes here, this may become 100. If market goes here, this will become 200. So how much far the market goes, how much fast it goes, that much fast these numbers will rise. Who decides this number? No one. Buyer and seller auction decides this number. So there is no such formula that these numbers will come automatically. It is an auction, betting going on. Who decided that for India for 1 rupee we have to get 1.5 rupees? During the match, who decided that for India for 1 rupee we get 10 rupees? It is all buying and selling of the betting. As the match is going one-sided, the risk reward reduces. That's how it happens here also. As the price keeps on shooting up, these premiums will explode. How much big jump comes, that much big jump will come here also. So the call premiums are totally the reflection of the underlying instrument price rise. Forget put, only focus this one for time being. Alright? So there has to be some break even point, right? Now one thing that I know, that let's say Nifty itself, will take an example, that the price of the Nifty is likely to shoot up before 17th November, because 17th November contract is what I'm taking, which is next Thursday. So I know that I have to buy a call. Now which strike price to be chosen, I told you that is according to the risk appetite. But the premiums of the call will rise when the underlying price is rising. Hope the point is clear. So write down. In options, you will find an chain of now if you see, market fell down yesterday. It fell down by 128 points, Nifty. So what should happen to the call? All the call premiums went down. That's why you see the change all in negative, 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 negative. Meaning, day before yesterday, this was 24 plus 36, which is 60 rupees. This was 60 rupees, which has become 24 rupees in just one day. On 9th of November, this was 60, and on 10th of November it became 24. There's a huge loss in the premium. There's a huge erosion in the premium because the price fell down. But if the price rises today, it is going to rise by at least 300 points. If the price rises today, then this will recover and it may cross again 60. This is a real time. The movement will be very, very fast, like a stopwatch, you know. The market is moving 50, 70 points here. Here this will be moving by 10, 20, 30%. In every minute, 10, 20, 30% up or down. That is why people enjoy doing options trading. Fast money or out. The biggest advantage to the option buyer is that they may only lose the premium. Like say that I am betting with you that I have lot of strength, right? That if I throw a ball and it goes to 500, 600, 700, 800, 900 meters, 1000 meters, 2000 meters, 3000 meters, I'll be rewarded. Every 100 meters, my money gets double. Every 100 meters. But the risk what I have? Only 100 rupees. So for an option buyer, worst case is that they will lose this premium. That means if I am wrong, if market doesn't cross this, rather market becomes zero. Let's say Nifty big crash against another COVID wave, and the price from 18,000 goes to 8,000, goes to 5,000, goes to 1,000, goes to zero. You will still lose only 24 into 50. That's all 1200 rupees. That means if you are wrong, if you are too wrong, if you are extremely wrong, you will only lose limited amount. But if you are right, you are very right, you are extremely right, you will be rewarded multiple times. That is why the risk to reward is in your favor when it is option buying. Hope it is clear. So very, very important point, note it down. For an option buyer, the maximum risk is only the premium into lot size. Even in worst case, the loss is not beyond this. Just like saying at the down there is ground, but at the top there is sky. 18,000 may become 30,000, but 18,000 cannot become negative, right? So for a buyer, there's always an advantage, and seller will always be in a stress because losses can be unlimited. All right, so this point is very clear. Now, what is the break-even point? For any call option, to know the break-even point with regard to holding the position till the expiry. For any call expiry contract, to know the break-even point with regard to holding the position till the expiry, just add the respective strike price CE premium to itself. Example, Nifty 18,000 CE call expiry 18,200 CE is trading at how much? 73. Of course, it is into lot size. So I'm not mentioning again and again lot size. Very important notes. Any confusion, you can ask me immediately. Options is one such thing that do not leave any question or doubt in your mind. Otherwise, you will not be able to follow the entire subject. The things will become more and more complex when I talk about double combination, triple combination, four leg combination, future plus option, CE plus PE plus future, buy CE, sell CE, buy PE, sell CE. Now that so many combinations we'll be doing, which is what is your hedging strategies. So if you are not able to understand the basic thing itself, then those complex calculation will only be a question mark for you. And there are a lot of videos even in the local language. Today your homework would be to know completely about the CE and PE through your favorite videos in YouTube. You just type in YouTube calculation of call expiry and put expiry in options, or just type options trading basics. You'll find plenty of videos in Hindi, in Telugu, in every regional language. Go through it, subject will become little simpler. So one thing that we have understood so far is that CE premiums will rise when the price is rising. Whichever instrument you have taken, let's say we are talking about Nifty right now. So whatever is the premium that you see against any strike price, if you add that to the strike price, see this is what we have seen here, 18,200 strike price, and for that the price is 73. So if I add up both, I get a break even point for me. Now this is like a Lakshman Rekha for me. So one figure is already there in my mind, that 18,273 till the expiry. Any price above this I will make money. How much above this, that much money I'll get it. If it is 18,400, I'll make a lot of money. 18,600, I'll make hell lot of money. 19,000, it's a jackpot. 20,000 is a lottery ticket. This is a break-even point. I told you, remember the flag and the ball example. How much far my ball goes, that much money I'll be getting. So this is like my first flag from where I'll start getting profit. My first target point where my capital is protected. And beyond this, how much my ball goes, that much money will keep coming. But below this, let it go to even zero, I will lose only this one. So profits have no limits, losses there is limit. Hope it is clear? So let us now assume an hypothetical example that Nifty expires at various points. So Nifty may expire at 1,000 rupees, who knows? Of course, it will not become zero because companies can't be available for free. Or it may expire at 10,000. Okay. Or it may expire at, let's say, 15,000. Could be 18,000 or 18,200 or 18,273 or 18,500, which I'm expecting, 19,000. Any of thing may easily happen in a week's time. Rising by 500 point, 1,000 point in a week is shouldn't be a surprise. This happens often. So this is the practical range that we have taken, which is this one. But this is rare cases. Such big falls in a week only happens when there is a serious bad news which affects the world. Okay. So one thing I know is what is my strike price. So that means my break-even point. So what this break-even point means is that at this point I am neutral. That means neither I will be gaining nor I will be losing. That means on 17th November, that is Thursday, at 3:30 p.m. our market closes. If Nifty is trading at 18,273, my premium will remain at 73. So something I bought at 73, I again sell it at 73. So what do I make? Nothing. That's why that's the break-even point. And one thing that I know, that any break-even point is what? Lakshman Rekha. So in one direction I'll make profit, another direction I'll lose money. So here definitely I would gain money. Why? Because we know that a buyer of a call makes profit when the price is actually rising, and he will lose money when the price is falling. So how much money we would lose? I told you maximum loss will be only premium, no matter what may happen. So here my losses are limited. Into lot size, needless to say. So you can sleep coolly, Tomorrow someone says that, "Arey, market crashed." Someone who has bought futures is already out. He has 1 lakh and he bought 10 lakh worth of future. Market falls by 10%. He's making a loss of 1 lakh. He thought market would rise. You're also thinking market would rise. But how much you would lose? Only 73 into 50, 3,000 rupees. You lose 3,000, he loses 1 lakh for 10% market fall. And 10% fall in the market is no big deal. It can happen in 3-4 days also, even if it is a small bad news. That is the difference between the futures and the option, guys. If the price rises, so how much? 18,500 minus 18,273. How much is that? 237 points profit. 27. And here 527. Sorry, 727. Amazing profit. So this is the difference you find. So if I'm wrong, I lose only 73, but if I'm right, I make huge money. If I'm too right, I make huge money. I multiply my money 10 times. If I am too right, anything can happen in the stock market. Position yourself wherein if you're wrong, you lose little, but if you win big. Position yourself like that to be a winner. But if you ask me, sir, what are the chances that this will go? Very rare, guys. Until and unless some serious good news comes, rising so much is also a very rare case. So don't think that very frequently you'll be able to make lottery kind of income or jackpot income. That happens once or twice in a year only. And majority of the time, the big movement will not come, a small movement will come. See, here the problem is Nifty is at 18,000, right? You felt that the price will rise. You felt that the price will rise, and the price did rise. But even after it rose, you are still making loss. So 80% of the time, the price doesn't cross the strike price at all. 80% of the time. Because your strike price is far away. I am throwing a ball and the ball has to go to 500 meters, then my profits will start. But 500 meters is not joke. Most of the time, the balls will stop at 100, 200, 300 meters only. Only among 10 people, one person may have that kind of strength. So always think from dual side. Though there is a huge profit and the loss is limited, but chances also you have to see. Na? Let's say in India and England match, England were 100 for no loss. That time for India 10 rupees, you were getting 100 rupees. But also see what is the chance of India winning. That also you should see. That was also like less than 10%. So do not ever come to a conclusion saying that, sir, buying option is only the best. I told you neither buying options is best nor selling options is best. Buying and selling options is best. Combination is good. That combination will be discussing later. Now, what will happen if the price is 18,250? This is important. So at 18,250, whether I'll make profit or loss, obviously I'll make loss. How much loss I will make? Worst case loss is this. But here what I'll do, the break even point minus the expiry price. I'm expecting that the price expires at 18,250 on 17 November. So how much loss it is? Only 23 points. Don't put as minus 73. This is only minus 23. Likewise here also. let's say the price expires at 18,300. You'll make profit. How much profit? 27 points only. How the profit will be 27 points? Because something that you bought at 73, remember, this will become 100 rupees. If the price expires is 18,300, the 73 rupees will become 100 rupees automatically. That is the formula, settlement formula. If you leave your position like that, the SEBI will settle this automatically at 100 rupees. Though you did not sell, but exchange will sell at 100. You are left, you bought at 73 and you went for a trip. You did not even log in. But tomorrow you see the bill, exchange would have sold it for 100 rupees. And the expiry is 18,250, you would lose only 23. Why how 23? Because this 73 rupees premium will become 50 rupees. You bought at 73 but you forgot to sell. Exchange will sell at 50 because that's the settlement price according to the formula. Hope so far we have only seen one leg. Simple one. Buying a call. Any doubts or questions you have got, you can clarify immediately. Tomorrow we are going to see selling of call with other strike prices. Then we'll see buying of put, selling of put. These are the 4 weapons we have. With these 4 weapons only we fight with the market. Over to you. That's all for today. Any questions or doubts, make use of the chat window or the audio control.